Good morning, everyone. My name is Jack Segal. I'm the CFO of Noble Care Consulting. And we are joined today by an all-star panel. Each of the panelists have deep industry knowledge and need no introduction because they are all leaders in the field of healthcare finance. Having said that, we are going to start with introductions. I took the liberty to really bullet down all of your lengthy bios, so feel free to chime in case I missed anything that you would like to highlight. We're going to start with Ari Adlerstein. Ari serves as a senior managing director at Meridian Capital Group and heads the company's senior housing and healthcare team. And now listen to this. He has closed over $17 billion in transactions through the course of his career. Alan Litt. Alan is a partner at Greystone, Monticello, and has over 30 years of finance, development, and construction experience. Prior to his current position, Alan was president and chairman of the Coles Company. Tony Ruberg, on my immediate left. Tony is a senior managing director with VIUM Capital, responsible for business relationships in the Northeast and Florida for the senior housing and healthcare sectors. Jim, the man all the way bringing up the rear over there, is the senior director of healthcare lending for Signature Bank and the senior credit officer for Signature Bank's new healthcare lending vertical. Jim has 30-plus years of experience in senior housing and healthcare. And last but not least, Jonathan Slusher. Jonathan is a partner at the Northwind Group and is responsible for overseeing all activities related to Northwind senior living and healthcare investments. What a difference a year makes. Last year at this time, the federal funds rate was at 0%. Today, it is sitting at close to 5%. 2022 was undoubtedly a period of very high inflation, with headline CPI hitting levels not seen in 40 years. To combat inflation, the Federal Reserve embarked on a path of aggressive monetary tightening, hiking rates at the most rapid pace since the early 1980s. As a result, borrowing costs have skyrocketed and financial conditions have tightened considerably. Although monetary policy affects the economy in uncertain lags, as the owner-operators in this room know too well, the impact is almost immediate for borrowers. For the many, hopefully not in this room, who are blindsided by the significant increase in the cost of capital, they are now facing compressed profit margins, if any profit at all, potential covenant breaches, and the prospect of capital calls to service their property's debt. Last July, when SOFR was at 1.5%, I was having a discussion with an owner-operator who has a large skilled nursing ownership. And we were discussing the outlook for interest rates. And he told me, Jack, the Fed is never going to hit 4%. And I told him, what are you basing on that? He says, I'll be honest with you, I'm not basing that on anything except if they do, I'm doomed. So, with interest rates now at close to 5%, Tony, I'll start with you. How is the industry holding up?
Thanks for the intro, Jack. And I appreciate everyone being here. It has been a wild year, coming off a couple years of COVID. Like you said, last year, interest rates effectively zero when we were at eCap, now significantly higher. I can only speak intelligently to our portfolio at VIUM. Some may argue I can't even speak intelligently about that, but I'll do my best. It's really been a dichotomy in our portfolio based on three main factors: Medicaid rates, agency usage, and skilled mix. Medicaid rates, I'll start there. Several states have pushed through pretty significant increases over the last year. It's been very helpful for our operators that operate in those states, and honestly, it's helped them sit in a really nice position. Indiana, Florida, Pennsylvania, you guys know the states that have pushed those through. The states that have not The states that skipped rebasing a couple years ago because of COVID, things of that nature, have experienced some, significant difficulties before we even get into inflation and interest rates being what they are. Several of those states, Ohio, Iowa, Michigan, we're expecting rate increases to happen later this year. We're all hopeful that that'll happen. Hopefully they'll be significant, but there's a lot riding on that. Agency usage goes without saying. We've seen it start to come down globally. Obviously, I'm speaking in generalities here. Some localities have done better than others, and where operators have been able to control that cost, it's made a massive difference. And then the last is skilled mix, and I'm not talking like the COVID skilling in place, but being able to truly drive skilled mix as electives came back after they were stalled during COVID and things like that. Operators have been able to do that, have had good success. So our portfolio generally is doing reasonably well, but we're going to have instances, and right now I'm sure we'll talk about the inverted yield curve, but we'll have, as we do year-end testing, deals that we're underwriting and ready to go to HUD that are also going to trip debt service covenants because of where short-term rates have gone versus long-term rates. So it's a very, very interesting time in that regard. And the last thing I'll say is, obviously there was heavy M&A activity from about the middle to late 2020 until third quarter of last year. We saw that stall significantly as rates jumped like they did. I think that'll bleed through into probably first and second quarter of this year, and as it levels off a little bit, hopefully we'll see that activity pick up again later this year, but it's definitely not stopped, but it's slowed a ton. Senior housing basically has stopped from an M&A standpoint.
So Tony, thank you for that. What would you say if for the people in this room that are not on the operation side, that are solely on the real estate side, how are they holding up?
It's difficult. I mean, a lot of it's going to depend on whether or not they protected themselves against a rising rate environment. Did you buy a cap? Did you do a swap? But even in those instances, a lot of those deals are 2 or 3 year bridge deals, right? And your note is maturing sometime this summer. We have a lot of that happening, and along with that, your protection is going to go away as well. And now you're fully exposed to rates again. So it's I would rather be an owner-operator right now, I think, than just a landlord. I think you have a little more flexibility in that regard, but it's going to be a partnership and probably a lot of difficult discussions in that regard.
I've heard some people in the industry calling those bridge loans the bridge to nowhere.
Yeah.
Okay. Ari, would you like to chime in maybe on the contrast between senior housing, AL, IL, with respect to skilled nursing?
I think your question was, how do we contrast senior housing to skilled nursing? Yeah, it's interesting. Obviously, to Tony's point, skilled nursing has been an interesting year for the last year. If you're a PropCo-only guy, you've done a lot of deals, and you didn't protect yourself with either a swap or a cap, a lot of our clients are underwater. And so pre this panel, I had the opportunity to meet with my fellow colleagues on this illustrious stage. They've all agreed to drop their rates by 5%. So congratulations. Yeah, they control most of the industry here. So I did that for all of you for free. You can pay Meridian later.
It's skilled nursing as well, not only in IL and AL.
Yeah, no, for the whole industry. So I probably uniquely play in both worlds. I like to say the skilled nursing world versus the IL, AL world. The two usually don't meet. Sometimes they do, but rarely. Senior housing is an interesting place right now, and I think that IL, AL people, most of the institutional guys are sitting on the sidelines, and that's been the case for a fair amount of time. Skilled nursing was, everyone knows, was particularly resilient. Thanks a lot to the government propping us up in this sector. I don't know. IL, AL right now is a space that I'm very wary of, but on the flip side, for the smart guys, there's always opportunity. It all comes down to the operator. So if you have a good operator, and I'm seeing transactions, and I'm representing transactions that I believe are generational. We're at basis of well below replacement cost for good real estate. So as a deal junkie, I think there's always great opportunity, even in distressed times.
Do you see a significant decrease in construction in the IL/AL space?
Absolutely, absolutely. If anyone has any construction dollars that they're willing to put to work, I'm looking. So it's very difficult to get ground-up construction done today. we've placed a fair amount of it. And interestingly enough, I've done more ground-up construction since the start of COVID than I've done in the previous 10 years of my career. And I think that's partially due to like the big institutional players that I'm proud to represent. They didn't really think that they needed ARI, pre-COVID, because, the big boys were just saying yes to everything. Today they need me a little bit more, and that's been good for me, maybe not as great for them, but I think we've done a good job.
Okay, thank you for that. Anybody else want to chime in on the state of the industry before we go on to the next question? So I guess to summarize, the state of the industry is split. To use Tony's words, there is a dichotomy in the industry, and you got to be on the ops. Otherwise, you might be in trouble. All right, so really, I think that's a great segue to the next question that I would like Jonathan to take up. Is the skilled nursing space in a bubble that was fueled by ultra-easy monetary policy?
So really every asset class in the country, valuations became pretty intense during COVID. A lot of capital on the debt and equity side. Kind of believe skilled nursing values were driven by different things. So Tony spoke about Medicaid rates. The progression of Medicaid rate, if you look at certain states that have gotten to a level of 250, 270 plus, where a Medicaid resident actually starts to become somewhat profitable instead of buildings just focusing on Med A, those valuations have been where the largest increases have occurred. And that's fundamental cash flow. That's what should drive valuation. So that's the Medicaid piece of the story is extremely important. Stroke of pen risk was always negative. When you talk about seniors housing and skilled nursing, most institutional capital focuses on ILAL because it's private pay, you can push rates, and it's more entrepreneurial. Everyone's very terrified of the federal and state governments dropping rates or not pushing rates when it made sense. We just experienced the perfect episode of the state and federal government supporting skilled nursing. And a lot of institutional investors, they're not out in the forefront yet, but they're certainly in the background financing a lot of debt and equity transactions that are going on in skilled nursing. The equity markets are still not doing so well, so the REITs are quiet, but the REITs will wake up when the equity markets consolidate, absolutely. The private-public partnership of skilled nursing is why institutions that are coming to assets that are newer institutions you've never seen before is why they exist, infrastructure funds, et cetera. We think that continues. The stroke of pen risk getting flipped to a positive is cap rate compression. Medicaid is cash flow growth. That creates asset value increase that we've seen. So rates certainly helped, but many of you in here are owners of the real estate and the operations, not just relying on a rent payment. The business is dynamic. There's ancillaries, there's services businesses. There's a lot that goes into a purchase of an asset. It's not just the beds. So that's why valuation becomes kind of a very dynamic equation for everyone. But we think asset values continue to progress so long as the Medicaid rate lobby continues and increasing institutional capital understands the space better, enters the space in more significant ways, just like it did in seniors housing the past 10 years.
So does the REIT model still work?
To a degree, when the equity markets consolidate and stock prices move, and many of you in here started with a few buildings, then a portfolio, now you have an enterprise. You've gotten to the point where your only exit or recapitalization where you remain in the business but change your capital structure is a REIT or an institution. And they will be active. Does their lease look the same? Probably not. It's already changing. They're already doing mezz and purchase options 2 years out so you can capture the upside. But it'll be modified. I think the institutions privately enter the space in a bigger way first, and the REITs will follow.
From your vantage point, how are you seeing deal flow? From the Noble Care side, we're seeing deal flow like we have never seen before. It's like literally drinking from a fire hose.
Yep.
But maybe that's just the strength of the operators that we deal with. but I really like to get all your perspective on what you're seeing with deal flow. Alan.
I'd like to just talk about Jonathan's point on you talked about a bubble. The valuations occur because over the last 8 or 10 years, there are a lot of very smart people sitting in this room that use technology, that work very, very, very hard, and we're able to find little segments of cash flow. And to Jonathan's point, he's 100% correct, that cash flow creates value. Value for us as lenders and as bankers, but also value for the operator. And I think that's why you're seeing it. The industry, I've been in it for 30 years, is very sleepy for 20 years. The last 8 or 10 years, a group have come in who are very thoughtful, very creative, and are using technology to create cash flow. And I think this is exactly why you've had the price increases. And as Jonathan also said, the government will stand behind this industry. There are no place for these residents to go. They can't go home. So where Ari was talking about the assisted living, which is more like, I want that for my mom, our industry is more, I need that for my mom. And I think that's what's creating this valuation.
Got it. But to your point, I really think the skilled nursing industry is really in an uncharted territory. Most operators in this room, I would think, never saw interest rates at this point, right? They're not around from the 1980s. Maybe some of the people on it.
So I've been here since thank you. I've been here since 88. But I think one of the things that I'm hearing from my clients, we're in this for the long haul. We met with a client yesterday. He's paying $3 million a year more in debt service. You look at the yield curve, the 10-year starting to fall. So are you in this for a quick pop? You're looking to make a flip? That might not be the industry moving forward. Those that have built platforms, that have built infrastructure, that use technology, that have great relationships with the hospitals, those are the ones that will survive and thrive. And the reason why you guys are drinking out of a fire hose is if you look at your track record, it shows you know how to make a profit and report and do all the things you need to do. So are you in it for the long haul or the short haul?
So I guess it really boils down to, are higher rates the new normal? Because if they are,
Yes.
there's a different dynamic to this entire industry that maybe has to be looked at and revalued.
Rates are decided by the government. They're not decided by anybody in this room. We all take the penalty of that rate. But we also all took the benefit. When SOFR, like Tony said, when SOFR was 0, everybody here was living La Vida Loca. It was great. Okay? But now it's a little higher, but are you in it for the long? I mean, you're going to have to pay for a few years, and then it'll go back to normal. You see the HUD rates are now back down 5 or a little bit below 5. That's what you should be looking at, is that rate. That's going to tell you, Tony's rate is going to tell you the future.
Well, we all know there's a great tension right now in the market between the Fed futures, what the people are saying, what the Fed is going to be doing, and what the Fed is saying they are going to do, right? So we'll see who wins out. Is the bond market going to win out to the inverted yield curve that Tony mentioned, or is the Fed serious and the Fed is going to keep rates longer, higher and longer, and that, right?
When you figure that out, let us all know.
Alan, that's why we hire you for that. All right? That's your job, not mine. Jim, how are you seeing deal flow on your end from the Signature Bank perspective?
Deal flow's been very strong. I can attribute some of that to the fact that we're the new kid on the block. But we want to grow this business and have had a really good first 9 months. I think deal flow is going to slow a bit in the first half of this year. You can't ignore the impact of short-term rates on underwriting. Even though we're seeing occupancies creep up, NOI creep up, they're not going fast enough to catch up with short rates. We're certainly encouraging a lot of our borrowers to go fixed. As mentioned a couple of times by the panel, longer rates are attractive, and we're willing to do balance sheet fixed. So we have that flexibility.
I think that's a great. I don't know if most people in the room are familiar. So you're referencing there's a product from Signature Bank to do a bridge fixed loan.
Yes. for example, our commercial real estate portfolio is about 50% fixed historically, so the bank is very willing to take fixed rate on the balance sheet.
How does that look? That looks like a floating rate, which is the same type of pricing as a cap. If someone bought a cap, is that analogous to that?
Some of it would be floating with a cap, but others would just be a straight fixed rate on the balance sheet.
Okay, we should meet later.
Yes, looking forward to it.
We have all heard, certain lenders that people in this room have dealt with in the past have withdrawn from the market. The people on this panel, the reason why they're here, because they did not withdraw from the market. But how does that impact really deal flow? I would think that there's such a smaller subset of banks willing to make loans in this environment that should really impact deal flow because there's just not enough, there's a limited amount of capital to go around. Ari, from your perspective, what do you see with the lenders withdrawing from this market?
My view, which is widely unpopular, is that we should all take a break for about a year and go to the beach. If you're me, which is interesting coming from
Is that in skilled nursing or in ILAL?
Both.
Both?
But
Okay.
no, yeah, I mean, in all seriousness, if you're somebody like me who places debt for a living, it's been an interesting time. A year ago, we'd be able to take a deal out to market, much to some of the fellow panelists' chagrin, and we'd have 6 term sheets 24 hours later and kind of feeling like you're king of the world, right? The biggest issue is how do we let down 5 lenders gently and respectfully because they've all put in time and energy into giving us a term sheet. And today, when we get a term sheet that we feel really good about and we feel like there's certainty of execution and the terms are livable, we are excited. And so that's certainly put a different dynamic into our job and also into deal flow for sure. I think a big part of our job at Meridian is setting clients' expectations, right? We're facing a very different time today than we ever have, at least in my 12 years of doing this. So, it takes time to get a term sheet. It's not going to be, you need a term sheet in a week from now. I'm probably not your guy. And that's just because I like to say, do what I say I'm going to do. And I just don't think that's realistic. Right?
Alan, can we come to you?
Yeah. Yeah, Alan will give you a term sheet
I'll
for
give
sure.
you a term sheet.
Yeah. But as long as Meridian's getting paid, Alan, we'll send it. But I think that setting expectations with our clients and saying this is an interesting time. You have to be willing to do some things that you maybe haven't thought of. As an example, one of the strangest things, but I think it's pertinent to almost everyone on the stage, is deposits. Right? I've never, until about 4 or 5 months ago, been asked, hey Ari, we need deposits. We need a bunch of cash for you to put up in the bank in order for us to even consider writing this loan. We don't even want to talk about the deal. Can you put up 10% of the loan amount to start a relationship? And to be clear, we're not talking about collateral. We're talking about just banking deposits, cash. And that's a sign of the times, right? So interesting things like that of something, that we have to navigate, but, continue to work through. It has affected, we remain extremely busy, but I like to say that we are working harder for the same amount. Right, we just have to be more creative and talk to our friends much more frequently to figure it out.
Alan, go ahead.
So you asked the question, is everybody busier? You're drinking out of a fire hose looking. We used to meet 3 days a week to do pre-screening. We're now doing it 5 days a week. We don't need deposits, so it's different dynamic because we're a fund, not a bank. But we're all looking at a lot more opportunities. But you, as everybody here, are scrutinizing those opportunities because of the risk of capital, right? It's much more expensive than it used to be to go do something. So now it really, really, really has to work. So you're looking, he's looking, everybody's looking a lot harder. And as Ari just said, maybe you don't get, you end up in the same place you were like 2 years ago, volume-wise, but you're looking at a lot more things.
So Tony, you wanted to chime in on that?
Yeah, I was just going to say, as you talk about, we called them the tourist lenders that came into the space and now they're back out of it. COVID knocked them out and you're back to sort of the groups that have been in the space for a long time. But one of the issues that we've seen is, through COVID, ramp-ups were slower, pro formas were hit at a slower pace, and so those deals aren't exiting to the permanent markets as fast. They're staying on a balance sheet longer, and most of us have a maximum amount we can lend to a single borrower. So you combine that with the consolidation that we've seen in the industry, more buildings under fewer levels of ownership. we're just maxed out on a lot of borrowers. And I know that's the case for a lot of other lenders out there where you guys might bring us a deal and we might love it, but we just flat out don't have the space to do it. And when you go to syndicate it, there's like 30 less banks in the market to syndicate to as well. So I'm sure you guys are running into that.
Jonathan, are you seeing a uptake in your, mezzanine financing given the decreased leverage? Are
Yeah,
people coming to you
Absolutely. I think when you look at banks, regulated banks that are most active in the industry, an inverted yield curve is very difficult for them to lend to. They're regulated, they have risk ratings. An asset that's stabilized may not cover. HUD financing works, but the short-term yield doesn't work for their internal risk rating, so they literally cannot put out $1. They're taking deposits because they have those issues across their commercial real estate portfolios. Those deposits help shore up and open up capital to lend in other parts of the business. So the slowdown of bank activity in skilled nursing isn't because of fundamentals. It's because of all of the other asset classes that exist at the bank that are struggling. If they have a large apartment portfolio at a 4 cap, there's no coverage anymore. They have to risk rate down, they lose capital, they have less allocation to other assets, right? So the inverted yield curve complicates the banks. Banks have to come down on leverage. That opens up opportunity for us, and we take B and mezz exposure. So that's why we've been very busy. Banks that have the long-term view will start to certainly get more active, especially as occupancy really starts moving. It's been a good 6 months of build. And the ones that are early will capture a lot of market share, but it's still going to be difficult for them internally to get those loans approved because of the inverted yield curve. It's just, it's a risk rating box that they have trouble meeting. So we think it'll be a very busy year because we don't see rates going anywhere for at least a year. The economy is still doing well. It's in a very odd spot where there's still job growth, unemployment's low. People are generally doing well. There's been layoffs, but it's been all white-collar layoffs. Hasn't really hit the factories yet. I'm not sure it will. So if that happens, that'll speed up rate moving down, but we don't expect much to happen in the next 12 months.
So I would just counter it to that rosy outlook on the economy, which we're going to hear from Jim later. That would really play into the Fed's higher for longer narrative, which from the real estate side can have a serious implications.
So if I could mention one thing to that point.
Sure.
Fundamentals should improve. Usually fundamentals improve significantly and then rates follow. It's the inverse in our industry because of COVID. Spreads will likely come in as fundamentals continue to improve. People will take more assets to HUD and recycle capital. It'll be a healthier relationship with who you're lending, who you're borrowing from, and how you're financing assets long term.
Got it.
A client last night said, I really need a recession, which is very interesting because of labor. We saw this week the labor numbers came out. Everybody's got a job who wants a job. So this client was saying, how do you engineer? I said, at Monticello, we can't do that. But they said, like, how do we can't do that. But how do you get a recession? Because a recession will create labor that we desperately need, which will help many of our covenants because it'll get agency out of the building and other things. So the economy is totally tied in.
So that's actually something that I was thinking that maybe Jim can chime in on. What are your thoughts how a recession would impact the skilled nursing facility industry?
Well, Jack, first I want to thank you for asking me the economics question. I am not an economist. I did not stay at a Holiday Inn last night. But I'll give it a shot. One thing I do have, though, is I have lent to the skilled nursing space for about 35 years. My first nursing home loan was in 1984 on the heels of the 81-82 recession, and rates were still in the mid-teens. We're talking Fed funds, not borrowing rates. And back then, we never really thought about rates as a problem. It didn't really impede our nursing home lending. A lot of that probably had to do with the fact that we were in a cost-plus environment for the first 15 years of my career. And for many Medicaid states, it was a pass-through. It really wasn't an issue. If you had a good building and you had a good operator, interest rates really weren't an issue. And I'll talk about that in a minute because that's obviously changed. So I started off at the end of that first big recession of most of our lifetimes, and I've lent through 4 more. And each time we continue to lend to skilled nursing, and I think skilled nursing has rightly earned the title recession-proof. I wouldn't say that's quite accurate today for some of the things that have been mentioned by a couple of folks.
I would just say that it's the skilled nursing industry is not correlated.
It's
to
not
the economy.
correlated. I would say it's still recession resistant. I mean, recessions tend to stabilize labor, which this industry definitely needs. It's the biggest challenge that's facing the operators out there, more so than interest rates. I mean, a Fed funds rate of target of 4.5 to 4.75 is still relatively low from historic standards. And I see Luann nodding her head because she spent a lot of time, like me, underwriting with Fed funds rate in the 5 to 6 range. And we did it all the time. So interest rates aren't yet the problem that labor is. And I agree with your client that while nobody would necessarily wish for a recession would be a very good thing for the skilled nursing industry. And recessions have historically been good for skilled nursing. The other thing skilled nursing has going for it, other than the fact that it's always been need-driven, and it's even more so today, as the industry, looks to become a hospital replacement in many cases. We talked about Medicaid value, Medicaid driving value. I think that with special needs plans, the long-term Medicaid resident is more valuable than it's ever been in the 35 years that I've been lending to this industry. So I'm kind of bullish on the industry when it comes to the ability to make it through the next recession. I am concerned, though, that the situation is a little different. We have high interest rates as a result of significant inflation, but we also have very low unemployment, and that's just not a combination that we've seen. If you look at the charts, which I did prior to today, of the recessions, what happened during and what happened after, and we really do need unemployment is really the key. It's going to drive our whether we can get adequate staffing, and adequate staffing is going to allow the industry to increase occupancy. There's demand out there. Hospitals have no place to put people. So I think that everything is there as long as we can kind of deal with the staffing problem. And I know many operators are using all kinds of tools. They're using technology. They're using everything in the playbook to improve their labor situation, and they're going to have to keep doing that. A recession is not going to change that, so it's still going to be a hard job. But the other thing that skilled nursing has going for it is the feds, typically use, the FMAP increases, temporary increases, because recessions also bring large increases to the Medicaid rolls at states, and nursing homes benefit from that.
Right. So, but Jim, so just to
Obviously
summarize
to
what you're saying, is a recession would be good for operators because the recession would bring down labor costs, and a recession would be good for the owners of the real estate because it would likely bring down interest rates. I think that's
Yes.
what you mean to say.
Absolutely.
But I think someone might argue that a risk of a recession would be governments won't be able to fund Medicaid because there will be deficits. And I would like to know from maybe someone on the panel to chime in with their experience when there has been past recessions. Have governments cut back on their Medicaid funding when there was a recession?
If you look at a graph over the last 15 years, Medicaid rates have generally been in an upward trajectory. I don't recall, except for a few states here and there, having particular issues that would cut back on Medicaid.
I would say, Jim, what comes to mind is like the state of Illinois.
Oh, well,
Right?
The state of Illinois is a state unto itself when it comes to Medicaid.
Alan, what would you say about a recession impacting, state reimbursements of Medicaid?
So I think because the state's got a lot of stimulus, the budgets right now are full. So they have a few years to run. But one of the things we have to remember is that HUD, in the case of a recession, look at '08. HUD ran in and said, we will take down $13 billion. And they went to the industry and they took down a tremendous amount of debt at a very low cost. They were there for us because we all had loans, or I owned properties at the time, and HUD steps up. The government will step up. It goes to my thesis that I tell my investors. These residents really can't go anywhere else. And it's a lot cheaper than everybody showing up in a hospital for Medicaid. So they might not like it, but I think they're going to have to eat it. And the difference now is they're focused on quality and monitoring quality, and I think that they're feeling good about that part. Some operators here might not be happy with it because some of it is a little unfair, but the idea is I think they're starting to get, as Jim said, more comfortable 30 years later with this industry. Because when Jim started and I started and Luann started, the people in the nursing homes were walkie-talkies. They were like assisted living, like what Ari would do. These people now are critically ill and need care all the time. So I think the difference today than from the last recession or from '08 or before is the residents are sicker, they're more clinically complex, there's dementia that's raging, and so I think that gives us a little bit of a buffer protection.
So let me ask you, I would think that a recession would impact the bank's balance sheets and might impact their ability to go and lend through a recession. That might put something like Greystone Monticello, that's not a traditional bank, that might put them in a better position to go out and lend. What would you say to that?
So I think all of us, like Jonathan, myself, even the VIUM guys, we're private capital. You know, VIUM has some relation with the bank, but generally private capital. But whether it's us or whether it's Jim, I mean, you guys bring Jim $10 million in deposits, he can lend. The bank's pretty simple. It's 10 times, right? They go to the Federal Home Loan Bank, they borrow 10 times for free, and they can lend $100 million. So that's why they need the deposits, and it makes sense because they want to create and put liquidity. The government wants us to put liquidity in the system. If we all pull out liquidity out of the system, our investors say the same thing: make loans. Liquidity is very healthy and very important for everybody here and everybody in other related industries. We have to have liquidity.
Jonathan, you wanted to just say?
Yeah, so when you think about the banks, right now they're acting like a recession's coming, but it's uncertain. When a recession happens and it's absolutely in recession, I usually think the banks turn the spigot back on. They like certainty. That's how they risk rate, that's how they manage their book, that's how they hold capital against the risk they're taking. When there's uncertainty, they don't know what to do. So recession is bottom for a bank. That's when they exist and should be lending dollars. Banks don't want to lend dollars to the top, technically. That's usual cycle. That's usually what happens. Everyone overextends themselves, but certainty should create more liquidity from banks. So I actually think it's going to, when recession hits and banks come back in a more meaningful way.
And this industry has a tremendous amount of private capital. It's one of the few industries that I see that has so much private capital versus just banks.
And I would say that in a recession, relationship banking is probably the most important. And I can say from the Noble Care, every single bank on this and every single broker on this panel has stepped up for our operators, and we're thankful for that. So thank you all.
We're all just here to service Freddie, is what it comes down to.
Tony, I think we tapped out. You're tapped out with us. So Ari, the next question I would like to pose to you: how are you advising clients to manage interest rate exposure for new acquisitions and existing portfolios?
First thing is, obviously, you need a really good broker. So that goes without saying. But I think in this environment, like every situation is different. So really, what is the short-term and the long-term goals? As a few of our colleagues here have talked about the forward yield swap, I think that rates, if you look at the charts, right, they're projected to be topping off around 5%, then starting to come down a little bit. So, you know, that means a couple of things, right? First of all, maybe you swap a deal, but are you swapping it at the top of the market and you're losing all your potential downside or upside? You know, if rates come down, and you can actually benefit from a lower rate. So if you're swapping, you're fixed and you're done. So that's the good news and the bad news about a swap, right? You're providing yourself with certainty. You know what's coming, but you also don't benefit if rates come down significantly. So really, what is your long-term goal? So if I'm going to HUD in a year from now, I don't know that I want to put a swap on it. I'm going to deal with swap breakage. Swap breakage, if rates go down, are going to cost me an arm and a leg. So the good news is cap rates, or caps, I should say, the cost of caps have come down significantly in the last couple of weeks. And so like 6 months ago or 4 months ago even, we were looking at caps and you're doing a $20 million deal and you're like, oh, the strike price on this cap is a bloody fortune. And today it isn't. And you're doing a $20 million deal, just buy a cap. And you're providing yourself with that certainty. You also, again, need that great broker to make sure that Alan drops his or SOFR floor, you know, before, yeah, exactly. Thank you. So before you sign the term sheet. So, but in all seriousness, there's also a cancelable swap, which you can pay a couple more dollars, and you have the ability to still provide the certainty of the swap, but also be able to get out of it without it costing you an arm and a leg. So I really think, like, look, if you're a long-term holder, you want to put your asset to bed, we should price the swap and see what it comes to, and if the numbers work, maybe you just want to sleep at night. On the flip side, buying a cap today feels like it makes a lot of sense.
So you wouldn't recommend to go and fix? Is that accurate?
Look, if you're using Jim's balance sheet at Signature and they're going to provide a flexible fixed rate option where maybe some standard step downs and prepay, and then we can get out of it, or if you take us to HUD through Tony or Alan, we'll shave some points off the exit. Yeah, I mean, that feels great. But if you're going with a swap where it's going to cost you money, similar to Fannie and Freddie when they have yield maintenance or defeasance, that stuff gets pretty expensive, and I don't know, I'm all about flexible prepay if we can get it.
I guess the only last question is, at what strike are you advising your clients at this point?
Did you say Yoni? No.
What strike? At what strike?
Sorry. I think you got to look at, we just use a little calculator and kind of just price it out, and it really there's no right answer for that, right? It really just depends on what your risk appetite is, and also, frankly, how tight your deal is, right?
Yeah,
if you're
mean what it would take to get the deal done.
Yeah, what does it take to get the deal? We want to get deals closed, clearly, right? And so if you have the risk appetite, you know, spend a little less money today, but also know that you are protected.
Okay, we have 5 more minutes left. I just want to get in one more last question for Alan. Alan, how do you plan to deal with assets whose loans are maturing but not performing well enough to exit?
Kick the can down the road.
So, Alan, do we have a firm commitment from you that you're going to extend the loan?
Everybody gets a free extension. This all relates to your initial discussion, lenders working together with borrowers. If you have a borrower that has done a good job and has tried and has been transparent, every lender here, every lender at this conference will always try to work with that borrower to make it work. It's in everybody's interest to do that. And I think the interesting thing that we've seen over the 9 years we've been doing this is those that run in early get more than those that run in late. And so it's always trying to be ahead of it, and then that way everybody could get comfortable, they could process it. No one likes to get punched in the face. So the idea is that no one's running around taking people's assets away. I mean, it's just like, that's not what people want to be doing. But at the end of the day, there has to be a collaboration between all of the parties.
Do you have that flexibility? If it's not a balance sheet loan, it will syndicate it?
Yeah, we do. Because we're now holding everything on the balance sheet.
But I've also seen banks work really closely with their clients to, you know, you don't necessarily need to pay us down by 50% or, you know, some crazy ask, but we're going to give you 12 months, basically with very little covenants or no covenants, but you got to pay us off in 12 months. And so the part that concerns me is that banks have been doing that for the last 2 years or so, and I think that I'm starting to see a fair amount of fatigue from those lenders that have given those courtesy extensions, right? And we've gotten a bunch of inbounds from friendly lenders that are saying, look, Ari, can we engage you to take out this loan off our books? It just can't be on our books anymore. We don't want to necessarily go to war with our client. We most certainly do not want to own this asset, but we need to be proactive. We can no longer have this on our books. And I think that that's going to continue to be a big problem this year because there aren't a lot of homes for those deals.
Just a word about covenants. I know at Noble Care, we pride ourselves that our operators have never been ever in a technical default. However, how much flexibility do banks have to work with people that unfortunately are in technical default?
So one of the things I saw recently is a borrower came in and actually is going to spend a lot of money and buy a cap in the money to get him back in compliance. Posting interest reserves, other things like that, help it work for everybody. So you just got to be strategic about it. You just can't come in and say, do it for free because, there has to be this collaboration.
Yeah, I think that the point Alan made earlier, folks who come to us earlier, if you're 6-9 months ahead of your maturity, and at VIUM we call it having an adult conversation, but let's talk about really where does this asset sit? Is it going to get to the pro forma? If not, and let's try to solve this together. We want to be good partners. We've started looking at the in-the-money caps as well. It's a unique time with the shape of the yield curve that makes a ton of sense. It makes a lot of sense on acquisitions. If your lender's asking you to post an interest reserve, look at an in-the-money cap. It can be the same amount of money, and you're not posting a reserve, right? But the point is, the more you communicate with your lender, the easier it is for us to have flexibility with the borrower.
I would just like to open it up to the floor. Freddie Friedman would like to pose a question to the panel.
Of course, Freddie has to say.
Of course. 22 is a terrible year for a HUD lender. It seems like nobody really exited. What does the panel think about 23 as far as HUD? Are we going to be able to exit? What do you think about this administration? And what is the resolve if HUD just gets tighter and tighter like we've seen in 22?
Thank you, Freddie.
Do you want me to start with?
We'll go down the row.
We think HUD volumes will be down considerably this year. They were relatively normal last year, but a lot of that was still the A7 boom in the first half of the year that ended as rates started to go up. HUD has implemented some things that made it much more difficult and lengthy, even by HUD standards, to get deals done through COVID. They've walked back a few of those items that caused us real problems. I think it slowed up a deal we did with you guys. But they're also in the middle of this new handbook release, and it's got any HUD lender in the room will tell you we're in a little bit of a gray area right now as far as what's going to come next. It was supposed to be implemented earlier this year. Now they're telling us later this year. Some things are good in there. Other things will be problematic. So it's very much gray area right now for us. But we've been able to push deals through faster. The queue is down considerably, so the time frame has sped up a little bit. But there's still a lot of uncertainty on the HUD side right now.
Thank you. Jonathan, what do you think about the HUD?
So, take your portfolio, your Ohio assets. They'll be rebasing in the summer. You need T12 of that new rate, right? So there are certain states where there's continued progression in Medicaid rates where you're not going to want to go to HUD yet. You're going to want to wait. So the interest rate risk management piece of bridging to that new rebasing of really nice Medicaid rates becomes really important. Look, HUD underwrites fundamentals, and if an asset's performing well, and the operator has a very good reputation, HUD's open for business. But it's very complicated because of all the Medicaid rate movements and grant money, et cetera, that's been flowing through income statements. It makes it complicated for them, so they pull back. Once that gets a little more clarity, hopefully through next year, I think next year will be a significant year for HUD.
Thank you. Alan, I was actually talking to one of your colleagues last week, Chris Clear, and he gave me a very interesting stat. There are only 18 deals in the HUD queue right now. That's mind-blowing. So, Alan, question.
It doesn't shock me based on what Freddie said. HUD has become this year, because of what Jonathan said, they're wondering what's in those income statements. And I think Jonathan's 100% correct, that as soon as some of this flushes out, a little bit of Medicaid rate, but I think all of us as lenders know that, and we're very patient and say, okay, if we got to go another year, another 2 years, it's not going to freak anybody out. Let's just work with it, and let's move it along, because in another year, they'll be able to feel more comfortable. And I think it goes back to the recession. If there's a recession, we've seen in the past where HUD really steps up to help with capital and liquidity in the market.
Excellent. Ari, any thoughts on the HUD process?
There are way too many smart people in front of me for me to answer this question. So I'm just going to say thank you to Freddie for sitting here so patiently while your CFO is up on stage. I know that's hard for you. So on to Jim.
All right, Jim, last thoughts.
No. We're not HUD lenders. Our portfolio hasn't been around long enough to have gone through that cycle. We're not focused on it. We would prefer to keep the assets longer, keep the relationship longer, keep the deposits and banking services and grow those. So it's not really on our radar.
Okay, excellent. There's definitely a need for that in the market. So I would like to thank this all-star panel for taking the time out of their busy eCap summit to really lend up their knowledge and wisdom for everyone. So thank you all.